While the stock market is currently close to its all-time high, it has made many great investors such as Warren Buffett be more cautious about where to invest their money right now. And so today I'll share with you 4 of the best ETFs that have the most potential of long-term capital appreciation despite the current economic conditions. Without further ado, let's take a closer look at the first pick on my list. Historically, the stock market, and most precisely the S&P 500, has been able to return on average about 11% per year over the last couple of decades. So on your side, if you want to be able to capture a certain portion of this total return, a great option for you could be the Vanguard S&P 500 Index ETF with the ticker VFV. Indeed, this ETF that is tracking the 500 largest American companies in terms of valuation could be a great way for you to hold some of the most notorious companies in the entire world. It is why amongst the largest holdings of this ETF, you can find well-known companies such as Apple, Microsoft, and Nvidia. And in fact, these 3 companies only by themselves represent about 20% of the total assets of this fund. This also makes that with no surprise, the technology sector comes as the largest represent sector in the fund with about 30% of the total assets. And then you can find the financials, the healthcare, and the consumer discretionary sectors. On your side, by investing in this ETF, you could expect to pay some annual management fees of about 0.09% per year or $9 per $10,000 invest. Plus, 10 years ago, if you would have invested $10,000 in that fund, it would now be worth over $48,000 or an average annualized return of about 15% per year. And over the last year only, this ETF has been able to return to over 35% of profit. It is why Morningstar on its side consider that this fund has more potential of return compared to the average funds of its category while having the same level of risk. It is also interesting to note that VFV is making some quarterly dividend distribution to its shareholders with a dividend distribution yield of about 1% right now. All of these characteristics makes that this fund is pretty valuable for anyone's portfolio. Now for the second ETF on my list, we'll be going in a pretty complementary market to the US market, which is the Canadian stock market. Whereas the American market tends to fluctuate more in terms of valuation, meaning that it has more long-term capital appreciation potential, the Canadian stock market is often considered as being more defensive while having great defensive and dividend stocks in it, meaning more dividend income from it. And so one of the best funds to track this market would be the BMO S&P TSX Capped Composite Index ETF with the ticker ZCN. In total, this ETF includes over 200 top-ranked Canadian stocks that represents approximately 95% of the whole Canadian equity market. And so amongst its largest holdings, you can find well-known Canadian companies such as RBC, TD, Shopify, and Enbridge. As I told you earlier, the Canadian market is often considered as being more defensive than the American market, meaning that with no surprise, the financial sector comes as the largest sector of the fund. And then we find the energy, the industrials, and the materials sectors. Over the past 10 years, this fund has been able to average an annualized return of about 8% per year, meaning that your initial $10,000 investment in it would now be worth over $25,000. On your side, by holding this ETF, you could expect to pay some annual management fees of about 0.06% per year or $6 per $10,000 invest. So even if this ETF is currently underperforming the performance of VFV, what is great about them is that they are giving some excellent dividend distribution on a quarterly basis of over 3% per year. And they also have more potential of return compared to the average funds of their category while having the same level of risk. So right now we are having one ETF that is tracking the overall American market and one ETF that is tracking the overall Canadian market. But what about the other international stocks? Well, to include a global overview of the stock market, and if you don't want to have to pick one by one the different ETFs that you want to have in your portfolio, you could decide to go for an all-in-one ETF that is tracking the global stock market. To do so, in my opinion, what would be the best options for you would be the iShares All Equity ETF with the ticker XEQT. By holding close to 9,000 companies in their fund, this ETF could be pretty interesting, especially for all the Canadian beginner investors that are looking to find their first ETF. However, it is important to note that XEQT has one characteristic that makes it quite different compared to their main competitor. Instead of picking stocks one by one, this fund will be investing in other funds of its same company that are tracking different important markets in the world. While we know that the American market represents by far the largest stock market, it is no surprise that we find that the iShares US stock market ETF represents about 46% of the total assets of this fund. Then we have the Canadian market ETF, followed by the developed markets ETF, and at the end we have the emerging market ETF. And so globally, the wide majority of the holdings of this fund are located in North America or in other big countries such as Japan and the United Kingdom. On your side, however, if you would invest in that fund, you could expect to pay some slightly higher management fees compared to the two other ETFs where you'd pay about 0.20% per year or about $20 per $10,000 invest. Since its inception on the market in 2019, this fund has also been able to achieve an average annualized return of about 12% per year, which would have transformed your initial $10,000 investment to about $13,000 right now. Plus, this fund is also considered by Morningstar as being more interesting in terms of the potential of return that it has compared to the average funds of its category, while having the same level of risk. Add to this on its side, XEQT is also giving some quarterly dividend distribution to their shareholders with a distribution yield of about 1.14% right now. And so if you're looking for one ETF to track them all, this type of fund could be the best for you. Finally, the last ETF on my list won't be that interesting for anyone that is looking to grow their capital as much as possible in the long term, but it can be pretty interesting for people that are looking for a great liquidity reserve where they won't have too much big fluctuations in terms of their capital while receiving great monthly income from it. To do so, in my opinion, the best Canadian ETF would be the Global X High Interest Savings ETF with the ticker CASH. The objective of this fund is basically to maximize the monthly income to its unit holders while preserving the capital and the liquidity by investing primarily in high interest deposit accounts with Canadian banks. It is why Cash is only investing in 3 high-yielding savings accounts from 3 great Canadian banks, which are the National Bank, the CIBC Bank, and the Scotia Bank. If you are young and your objective is to grow your net worth as much as possible in the long term, this ETF might not be the best choice for you. On the other hand, if you're looking for stability that will be coming in the form of a certain liquidity reserve, for example, if you have a real estate property and that you're looking to use these funds to pay different expenses in the short term, well, this fund can be particularly interesting for you if you're looking to generate some monthly income while also keeping pretty much the same amount of cash in it. Also, as you can see, the value of this fund will remain pretty much at the same level and will increase a little bit every day until the ex-dividend date arrives when the dividend is paid, and then the cycle restarts. Plus, on your side, if you'd be tempted to invest in that ETF, you could expect to pay some annual management fees of about 0.11% per year or $11 per $10,000 invest. On their side, the monthly income that is generated from the high interest savings account in which they are investing will obviously depend on the fluctuation of the interest rate from the Bank of Canada. And so it is why with the recent cut of the policy rate over the last couple of weeks and months, it has made decrease the total interest payments that are given by Cash, where they are currently sitting to about 4% per year. And so it is why this type of ETF will be interesting for you strictly if you're looking for certain capital protection by also having a certain liquidity reserve for the short term. So there you have it. Those are 4 of the best Canadian ETFs that any investors could have in their watch list for the future. Obviously, there are plenty of other great Canadian ETFs that could be interesting for you to have in your portfolio, but in my opinion, these 4 are some of the most solid ones. But on your side, if you're looking for other ways to invest in the stock market by making some stock picking and by choosing individual companies one by one, well, to find which ones are the best for the long term, check out the video that's gonna be right over here, and I will see you soon. Peace!